Regardless of whether you already have a credit card or you think about getting one, it is imperial that you know how credit works. After all, you cannot not know how a credit card works without understanding credit. And the first thing for that is the credit limit. Every credit card has one, and a reasonable number could be anything from 2K up to 8K. Now, this money is not free money, right? This is the money you can use even if you don't have it. This is the credit you have. It means you can borrow between 2 and 8,000 depending on your credit limit. This money will need to be returned with interest. And another important thing for the credit limit is the utilization. That means how much limit you have divided by how much you used. That majorly impacts your credit card score, which in itself again impacts how high your credit limit is, how good the rate you can get, the APR, the interest rate. In general, it would be best to use not more than 30% of the credit limit you have. Why? Well, it's quite simple. If you use more, that looks risky. And if there's one thing banks don't like, it's risky investment. No one wants to give out money only to never get it back. This does look risky, so instead of maxing out how much you can borrow, try to stay within the 30% range and just use the card for already planned expenses. For example, rent or utilities or groceries. This way, you use the card and build credit because you show them that you use it, but that you're good for it and you can pay it back. But you don't take any risk because you only pay what you would have bought anyway, stuff you have the money for. And as I mentioned, any money you do borrow comes with an interest rate. There are various types of interest rate. One is the purchase APR. One is the cash APR. One is the late APR. Slash the penalty. And then there is the intro APR. All of these are something you will get in contact with if you have and use a credit card. But still, let's talk about it. First, the purchase APR. This simply is when you buy something on credit, right? You buy something, you don't pay it all back in the same month. This is usually the interest rate you have to pay on that. The cash APR is when you go to an ATM and you withdraw some, well, cash. This rate usually is higher than the purchase APR, so you should avoid that when possible. The late APR slash penalty APR, of course, if you don't pay your rates, you will get a punishment. These rates are of course higher than the normal rates because they are, after all, a punishment. And the intro APR. Now, just like with most phone contracts or internet or anything that is a subscription nowadays, you usually get some free months or some reduced months. Often enough, you get 6 months or 12 months of 0% interest. Now, of course, this is not out of kindness. This is to get you used to the card, to get you used to spending with it. And because you don't have to pay interest, it doesn't matter if you leave it for a month or 2 or 5. But they want you to build that as a habit. After you are used to not paying back right away, your intro APR will run out. And you will go from 0% to over 20%. And then suddenly, every month you don't pay back, they profit. Now, you might think that's not much, but if you have a 1000 balance at 20%, that will suddenly, after just 1 year, be $1,200. All because you got used to not paying on time. And that is what they banked on. So let's get to the meaty part. How is interest actually calculated? It's a math topic, and I know no one likes math. No one wants to do math, but it's important. Now, you have the APR, right? And usually, well, it's even in the name. It's annual. So for math's simplicity's sake, there will be examples with real math. Let's say you have an APR at 36.5%, right? You get the daily rate. You get the daily rate by dividing the APR through 365. 365 days a year, 1 year, right? In this extra easy example, the daily rate is 0.1, right? 0.1%. That means every single day you pay 0.1% on whatever balance you have. If you have a balance of $1,000, then on day 1 of paying, you will owe $1,001. And on day 2, you will owe 1,002.1. And that will continue. If this is the balance and this is the time, eventually your debt will go like this. The longer you leave it be, the higher it will go exponentially. Because 0.1% might look small, but you do it every day. And every day you also pay 0.1% on the 0.1% before that. That's why it goes exponential. The longer you wait, the more screwed you are. But let's use a bit less extreme example, right? Let's say you have a balance of 2,000 and an interest rate of 24%, okay? Dividing that rate by 365 will get you something around 0.06%. Makes sense. And 0.06% from 2000 is about 132 a day, right? For one single day you pay 132. And over 30 days, that will get up to over $39. Almost $40 in the first month. And don't forget, it will only get bigger if you don't pay it off. Let's use an even more realistic example, right? And let me roughly show you how much it will rise. Debt time. This time, let's say we start at 5,000, right? 5,000 at, let's say, 22%. This is still a believable rate, and I would say it's a bit more average. So as for the graph points, so let's say 5,000, it's shocking how much it will rise. So let's say this is 10k, let's say here's 20k, and well, 30k would be above. So let's say 1 year, 3 years, 5 years, and all the way back here, 10 years, okay? After 1 year, you will already be over $1,000 in debt because your balance will have risen to 6,150, right? That is an increase of 1.23 times, almost a quarter more. After 3 years, you will shoot up to $9,000 at 9,300. That is a multiplier of over 1.8. After 5 years, you will find yourself at 14,000, let's say here. That is a multiplier of 2.8, almost 3 times. And after 10 years, at a rate which won't even fit on the graph anymore, you will be at 38,000. After just 10 years, 5,000 have grown to almost 40,000. Now look at this graph. It would probably look something like this. And don't forget, this is your balance. This is the money you owe. Crazy, isn't it? The vicious part is that every single day, the longer you wait, the money will grow even further. Because the higher you get, 0.05% doesn't sound much, right? But 0.05% of 40,000 is still, what, 800 bucks? 800 a day. But let's say you didn't borrow quite as much. Let's say you borrowed 1,000 at 25%. You have a bad credit score and that's the best you can get. So you don't want to spend too much, right? So year 1, 3, 5 and 10. You started at 1,000. Not terrible, you can probably pay that off pretty quick, right? But let's say you forgot. Happens. After 1 year, you will be at 1,280, roughly there, right? After year 3, you will be at, give or take, 2,000. 3 years and your debt doubled. Still, if you take it serious, you can probably pay it off fairly quickly and you can take that as a learning money, right? The price of learning it. But if you forget about it, after another 2 years, you will be at over 3,000 with about 3.2k. Suddenly it more than tripled in just 5 years. It's a pretty bad rate if you ask me. But let's say you still forgot about it. Letters didn't reach you, I don't know, life happens. After 10 years of not paying anything on that $1,000 debt, you will be at 11k. 11k, that's more than 10x'd in 10 years. At a 25% rate. That's not a 100% rate, right? You don't have to pay $1,000 a year. That's not what you were told. But suddenly it 11x'd. Look at this graph. It's not perfect, but it shows you how vicious daily interest is. I mean, just look at what even starts here already. This arrow goes almost straight up. Ignoring your payments is a surefire way to get you up to the eyeballs into debt. And you won't gain anything from that. In the end, this is how a small balance balloons out of control. It can be anything as simple as concert tickets, a vacation, or maybe a festival. Or maybe it's those boots you liked, or that jacket, or that new iPhone. Some might tell you that you should carry some balance because it will build your credit score. But that's just a myth. Because all the banks see if you have balance that you don't pay off is that you don't pay off your balance. That doesn't make you more credit worthy, that doesn't make you more trustworthy. It just shows that you don't pay off what you have. No, let's be honest though, that's the worst case. If you don't pay anything at all to a credit you have. Since credit cards also offer rewards, we shouldn't ignore those. If you pay back fully every month what you borrowed, then anything you might get like credit points or miles or cashback is basically free. The only thing it takes from you is discipline. For example, if you spend 500 a month at 2% cashback, that's annually $120 for free. Only if you pay it off properly. Because any balance you have, once that interest takes hold, you're not gaining anything. I know this was a pretty dry video. Very math heavy, very bad sketch heavy. But I do hope it helps you not make mistakes. And if it does, like and subscribe. But if you think, oh man, credit cards sound pretty bad, you can try this video. Or if you think, ah man, had I known that sooner, now I'm in debt, you can try this video down here. I hope they'll help you. See you later.